So this morning, thank you both, Michael and Ray, for being on time. Yay to you guys. Because of this, you're gonna get some you're gonna get some bling. Mr. Brady is gonna we're gonna work a deal out to get some Midland shirts, right, Brady?
That's right. Yeah, whatever we can do to help.
Hey, I like it.
So yeah, we have Brady on this morning and Danielle, who works with him to be able to do some more reviews on the illustration software with Midland. And also we wanted to go over a little bit more on just field underwriting, some of the advantages that they have with on the carrier side that they're the business they will accept more frequently than some of the other relationships, like with North American, it's their sister company. And I know there's some nuanced differences that I've experienced. So I just wanted them to come in and present this morning to go over this, and then we'll pick back up on the marketing stuff next week. So, Brady, I'll hand it off to you and Danielle, however you guys want to launch from here.
Yeah, I think a good place to start is with Danielle. Most of you who may not be familiar with Danielle or haven't met her yet, Danielle is the internal wholesaler for the Midland national team here that I am on. I usually represent Indiana and Kentucky, but working with you guys, we've made an exception internally. Peter and I have a great relationship, working relationship, and you guys will be solely focused on our team instead of splitting you guys up internally. But Danielle, if you want to start, do you have the illustration software opened up? Do you want to
Um,
start with that, and then we can kind of get into
yeah,
Q
let's
and
do it
A's?
big.
Yeah, absolutely. So yeah, let me get some illustration software pulled up. Yeah, so like you said, my name's Danielle. I am the internal for the region, and I'm kind of going to be your guys' traffic controller. So if you have questions and you're not sure where to go, please feel free to include me. I'm here to help with anything that I possibly can, including making sure that your guys' illustrations are ran properly. So let me get some illustration software pulled up here quick, and then we'll go over just kind of the basics. Peter, is there a specific strategy at all that you want me to cover?
So we have a mix. We have a mix of IUL and term writers on this class generally. Like I said, we'll have some more people drop in here shortly, but I want to do both illustration modeling so they can see, you know, a traditional death benefit focus with the Protector series, right? And
Okay.
then because we want to have that alternative. Okay, if we want to have the cheaper permanent coverage as it compared to a term contract, which product will we use and make that happen? And then obviously just show once again the term and any nuances that are important for them to understand on the rating class differences on the terms for for like diabetes type 2. Do we know at what point are we dealing with those table ratings right off the bat?
Sure. Okay, perfect. So what I'll do is I'll go over then just kind of some of our basic illustrations and the actual case designs themselves. And then we'll kind of dive into that. So let me get my screen shared here. I'll get the right one. Okay, I'm not sure if any of you guys are familiar already with iPipeline, but that is the software that we currently use. So if you're familiar with it, this should be easy. And really, when we get into things like the different products, um, usually the illustration itself is going to be very common. For a guaranteed product, you're pretty much going to be running them all the same. Where the change comes in is what the concept is that you're selling and how you're phrasing that to your client to make sure that it's the best fit. So everybody can see my screen, yeah? Okay, perfect. So I'll just do one on myself just so you guys can kind of see. And we're gonna start with the Protector. That's our guaranteed IUL product. Um, Terms should be pretty self-explanatory to you guys. But I will show you one thing on those. So we'll start with our guaranteed IUL product. So you're gonna see all of our products here. This is going to be the one that is most commonly used for pretty much anybody that's not in the state of Oregon. So if you're writing business in the state of Oregon, they did not get back to us in time for product launch on approving the second version of our guaranteed IUL. So if you are in Oregon, you will be using this one. Otherwise, go ahead and use this one, and we'll go right into the quote here. I will always do a full illustration platform. The Easy Solve just doesn't give you the options that you're going to want, and it's not going to give you the best chance at winning the case, okay? So you can see here, obviously everything comes over. It will default to a class of preferred non-tobacco. This part is going to be where your field underwriting comes into play. But typically, if you guys haven't said anything to me or you're not 100% sure on their health, I would just run them at standard non-tobacco. And then that's going to give you the options if there's a table rating that's going to be involved, if there's any flat extras going to be involved. And then with this product, we do have the option to guarantee or not guarantee. It will default to guarantee. That is what I would recommend. When we guarantee this product, we actually waive the no lapse guarantee period because it's already guaranteed. So there are chances that it's actually going to be more affordable to include that premium guarantee rider than it would be to not. There have been a few examples here and there where it's been vice versa, but mostly it's best to have it within. And then solve for, if you guys have not ever ran your own illustration, basically to figure out what you're solving for, what are you missing? Do you know the death benefit and you need to know how much the premium is? Or do you know the premium and you need to know how much death benefit that's going to get you? So for me, I know what my monthly budget is. So I want to solve for how much is my money going to get me in death benefit. Okay. We do have these additional solves here that show distribution. The protector product, because it's a guaranteed death benefit, is primarily focused on the highest death benefit with the least amount of premium. You're not going to really be running a distribution on this. That's going to be a different product. So we'll talk about that later. So we'll start with death benefit. I want my death benefit again to be guaranteed. Guideline premium test, you should be all familiar with that to make sure that it doesn't become a mech. We do have an increasing death benefit option and a level death benefit option. For cost, I'm going to leave it level. And then you can see here, when you're guaranteeing your death benefit, you can put this number all the way out to age 120. Whatever you prefer. The longer you guarantee it for, right, the more expensive it's going to be. Usually around 100, 105 usually looks pretty good. And then if you've got a lump sum you want to pay, or you just know the dollar amount you want to pay. So I'm going to say I can afford $1,000 a month, but I only want to pay till I retire. This product is extremely competitive with the lifetime pay option, but it becomes more and more competitive with the short pay options, okay? We're not going to add any loans or withdrawals. It's pretty straightforward. And then from here, if you want to play with the different index crediting options, you certainly can. All of the index allocations are right here, and you can see every single one. You can see what the default is, if there's a cap on that, what the participation rate is, if it's a spread index, what that spread rate is going to give you, okay? So we do try to default to something that's going to fit kind of every market, okay? So I'll just leave that for now. If you want to add riders, children's term insurance rider, guaranteed insurability rider, things like that, you can hit next, or there is a tab here, whatever you prefer. I'm not going to add any riders just for ease. So let's view the full illustration, and then I'll just kind of give you a quick breakdown of what is all on this illustration. Majority of it will be on all of our illustrations, no matter the product. So I'll just kind of cover this, and then we'll go into the meat of it. Okay, everybody can see this, yeah? Yes. Perfect. Okay, so obviously here's everything, right? Here's our main. So for $1,000 a month at age 38, I'm going to get over $1.5 million in coverage. And then as we go through, it kind of gives you a breakdown of everything, just like all illustrations will be. This one here, so if you have a client who's saying they want permanent coverage with low cost, this is going to be your product. Or if you have a client who's focused on long-term care, this is going to be your product, okay? All of our products include those living benefits, which I'm sure you've heard from Brady. So your chronic illness is going to be kind of that long-term care alternative. 2 of your 6 daily living activities is what comes into play with that. The benefit of doing it through our life insurance versus through a long-term care policy is we don't have a maximum of 4 years where they can elect this. Whenever they run out, they can elect for however many. So if you've got a client who's got a really high death benefit, they can utilize and utilize and utilize these chronic benefits over and over and over as long as they continue to qualify on an annual basis. And then it is based off of the death benefit, of course, at the time of election. So if you have an increasing death benefit option, as they get older, of course, their death benefit and their benefits are going to get higher and higher. Rule of thumb, we don't have a way to physically calculate exactly how much somebody is going to get because there are so many factors that come into play. Rule of thumb with this is use your client's age. So if they elect $100,000 and they're age 70, typically they're going to get around 70% of that. Then your fees, all of the things that are going to come out at that time. We don't charge anything in the policy. Everything comes out at time of election. So if you want 100,000, and if you elect 100,000, you can guesstimate, and somebody at the age of 70 is going to get about 70,000 actually in their pocket, and they can use it for whatever. We don't have rules like long-term care where they have to show receipts. It's just if you want to use it for a vacation, we don't really care as long as you qualify for it. Okay. All right. Comes into some of the other features that we have, like the protected death benefit. You can say, hey, I'm 84 years old now. I want to make sure that I don't use $100,000 of my death benefit to make sure that things are covered for my actual death and funeral costs. Overloan protection, same concept. We just say that we're not going to lapse your policy because you've taken out too many loans. Again, this product, you're probably not going to be taking out very many loans on, just because there's not very much cash value built into it. And then, of course, it goes into all of our included benefits. So it breaks down the terminal, the chronic, the critical, tells you how much you can elect at a time, and then what the maximum is for those. Okay. Same with the overloan, the protected death benefit. And then what's really cool about the strategic protector product is we also have what's called premium recovery endorsement. And I'll break this down and show you on the illustration where you can find it. But essentially, it's certain periods of the policy should they decide they no longer need the policy. If they terminate or surrender that policy within that time frame, they're going to get a portion or all of their premium actually back. Okay. So it's kind of a win-win situation. They're covered, but they can get their money back. And then this goes into some of our indexes, offer an interest bonus after a certain time frame. And then the selected rider was that guarantee. So the premium guarantee rider that I selected yes on that illustration, that's where that comes in. And we go into the indexes, of course. We give a breakdown of how things work. We give a breakdown of the historical changes, just to kind of show you how accurate our illustration should be based on those. And then we get into the meat of it. And so here you can see that initial death benefit. I did a level option, monthly premium at 1,000, breaks it down to annual here. Guaranteed, non-guaranteed, alternate is kind of a mix between the guaranteed and how we assume it's actually going to perform to try to give you that middle ground and really put your client's mind at ease. And then our non-guaranteed assumes. So of course, how we expect the market to actually perform based off of how it's been performing. So you can see I paid only to age 65. So I am paying a total of $324,000 into this policy, having $1.6 million in death benefit. And that death benefit, again, is guaranteed to last
Danielle?
me all the way to age 100. Yes.
So your screen is only showing us the illustration quote stuff. It's not actually
Okay.
showing any kind of
No,
spreadsheet.
you're good. Thank you for telling me. Let me stop sharing and reshare. Good.
There we go.
Okay. So I'll just run through this again really quick. So here's my death benefit, yada, yada, yada. Here is where those living benefits are. that we had talked about. So it gives you an estimate of how much they can elect based on certain ages. Again, that's going to be rule of thumb there, okay? And then just a breakdown of everything. So we'll go into the meat here again where I was at. And here is the guaranteed column, that non-guaranteed assume or alternate, which kind of gives a middle ground, and then the guaranteed assumed. Now you can truly show a worst case scenario and put this at 0% and really show a worst case scenario of how it would work. But because we've got that premium guarantee, there's no sense in this product to do that. So again, I'm paying $324,000 up till age 65, getting 1.6 million in coverage, and that is guaranteed out to age 100 here. Okay. Now, one thing I want to show you is the premium. Yes, go ahead.
On the living benefits, those amounts on the illustration, are those annual benefits, lump sum benefits, or monthly benefits? I see that the chronic illness says annually, but the other two do not specify.
Correct. So chronic illness, you can re-elect as many times as you have death benefit to be able to pull from. Usually we will leave and make sure that nothing goes below roughly around $10,000 in death benefit to make sure that there is something for funeral costs. Until you've reached that point, you can continue to elect this chronic illness on an annual basis. Until you just can't elect it anymore. And you don't have to take the maximum, you just take what you can get. Terminal illness, of course, is going to be a lump sum. And then critical illness, it is a lump sum, but it's not something that you can't re-elect. It's not a one-time only. So if you have a heart attack and then 5 years later you have another heart attack, those are two separate events, but both will qualify for the critical illness, okay? The chronic illness, you just have to be able to essentially recertify on an annual basis, and it gets paid out as a lump sum. You can just get it annually.
Thank you.
Is the critical illness weighted on here based on severity or not?
Let me double check. I believe so. We do have living benefits like little flyer things that will break down specifically, but yes, I believe so. It does get rated based off of the severity of whatever we went through, whether it was a stroke, heart attack, or how severe the heart attack was.
So that's the other part, George, is right now it defaults to the lowest level. But just so that you're aware, if it was a life-threatening situation, there would be a whole lot more available under that benefit amount. Once again, it's their doctors that certify that.
Yes.
So essentially,
your client's doctor, they go to whoever. Yep.
And I'm sorry I interrupted. So essentially, they just fronting the death benefit, and for whatever period of time it is determined, correct?
Correct.
Yeah.
Okay,
Yep,
thank
exactly. You. Yep. And so here's kind of how that breaks down. So with a critical illness, it's 25% of the death benefit on each election. So again, you can elect this multiple times. It's just a maximum of 50,000 because usually a critical illness is not something that is super life-threatening. Maybe we just have some medical bills, right? But it can turn into a chronic illness. So that could turn into a chronic illness benefit. Say you have a stroke and then suddenly you can't move half of your body, right? It's a critical illness that it turned into a chronic illness where then you can start electing that chronic illness, okay?
Hey guys, just to confirm, the critical illness rider is a severity-based payout. It's a severity-based benefit. So yes.
Yeah. So you can say, hey, I want 50,000, but when our underwriters review everything, they may say, well, it wasn't that severe, so you don't want to take 50,000. The less you take, the less fees you're going to have to pay anyways. So
Danielle, how far is to look back for the critical illness? For example, a person had cancer 10 years ago. How would this policy address that?
That would definitely be an underwriting question. I would have to ask the underwriters who deal with claims like this, but from my understanding, there's no look back. It's per event. It's not like health insurance where they're going to say, oh, well, we expected this to happen.
More than likely, guys, they're going to want to see if an election is made on a critical illness. They want to see that health concern happen in the last 12 months, right? So you can't say, "Hey, I had a heart attack 5 years ago. I'd like to accelerate my critical illness benefit."
Yeah.
It's going to need to be within that 12 months.
Yep.
Yeah, that's not what I'm asking. I'm asking that if a person who's had a previous condition, would the policy exclude them if they had another condition? Person has lung cancer 10 years ago. They go into remission, they come back, and they have lung cancer again. Will the policy honor that, or will it say no previous condition? That's my question.
Yes, it will. Yes, it will.
Yeah, because
if they are
what we would
re-diagnosed.
Yeah, if what would happen in that scenario, Mike, is if they're approved initially for these benefits, then we've already looked at that, right? So we've already looked and established that, hey, they had this, you know, if it comes back and it's worse, right? Or it just comes back, period, and they want some assistance, we've already looked at and approved them to have these benefits.
Thank you.
Yep, absolutely. All right, so the last thing I want to show you on this illustration was that premium recovery endorsement that I had talked about, where your clients could get a portion or all of their money back. So that happens at policy year 15, policy year 20, and policy year 25. They have a specific amount of days after their policy anniversary, those years, to surrender the policy. So say I wanted to surrender my policy after 20 years because I just didn't need it for whatever reason, I have paid $240,000 back, and I would get $240,000 back. Guaranteed. Okay. Now, best case scenario, right? If the well, I guess I shouldn't say best case scenario, but if the policy performs better than what we're at, better than the guaranteed, I'm gonna get whatever the surrender value is. It's just at that time, if the surrender value is less than my premium recovery endorsement amount, I'm gonna get the 240,000. Okay. So it's kind of a no loss situation there. Okay. What other questions do we have on this product specifically?
So that's a great point. I'm glad you brought that out with that option, because I used to sell the North American version, the Gen 8 and the Gen 9 UL contracts that had that same feature. And, you know, I would put this in. So look, you're buying permanent coverage. You could use it for this, you could use it for that. Or if you decide, you know, your spouse passes away and you don't need this policy anymore because it was there to protect them, then you bail out in year 20 or year 30, right? So it really is a great feature, because they paid 240,000 into this. If they get back 240, how much do they pay in taxes? Anybody?
0.
Very good.
They're paying 0. Yep.
If they get 244,000 back, they're going to pay taxes on the $4,000, right?
Yep.
So I appreciate you bringing out that.
Yeah. Absolutely. All right. Sounds good. Well, I'm going to go ahead and oops. Let's stop sharing on me. Let me reshare. Let's just do. There we go. Okay. This should share everything. So I'm going to change my product. You can go back to the beginning if you want to, or you can change. Now we have the accelerator. The accelerator product is not utilized very often. It is a cash value product, but I would say typically you're going to see this used for somebody who's moving money in, moving money out, or doesn't care if the policy's a mech. They just want to put their money somewhere else.
So the accelerator is the preferred mech contract then?
Yeah.
It is.
That's good to
Yep.
know. That's good to know.
Yep, that's the one you would want to use. And then our accumulator is going to be when you're looking for distributions for long-term distributions. So
The
I'll show
accelerator
you
has
that
that
one.
waiver of surrender charge rider on there, Peter and team. So fully liquid.
Yep.
What's the current fixed rate with Midland?
We have
On
a fixed account that you can allocate to that's upwards of 4% right now.
On the accelerator too is at 4%?
I believe it is on the accelerator as well. We most commonly see it on the accumulator, but yes.
All right, so here's our accumulator product. So again, you're gonna be looking at college funding cases. You're gonna be looking at supplemental, oh, my lights turned off. And you're gonna be looking at, I don't know how to turn the back on, whatever. There we go. Supplemental retirement, things like that. So again, we'll just use me. You will notice my age changed. Our term and our protector product are in age nearest, and our accelerator and our accumulator are in age last. So again, we're going to be solving for our missing item here. I'm not going to make any other changes. So with this one, because I want to see retirement distributions, I'm going to say I want to pay $1,000 a month until I'm 65. How much death benefit is that going to give me? And how much distribution is that going to give me? We want minimum face non-MEC because we want the lowest death benefit possible. And then nothing else really needs to change here. We can go about some other things, but typically this is how it's going to be ran. So because I'm showing distributions, I'm going to change my age on here to show I want distributions from age 65 to 100, and I won't mess with anything on there. I'm going to do the agent only report because it pops up a little bit faster and it just brings us right into the meat. The remaining stuff on the illustration is virtually the same. Okay, so right into the meat of things, you're going to see my initial death benefit is just under 700,000. I'm paying 1,200 a year, again, until I'm age 65. And potentially what that's going to do is get me nearly $80,000 a year in distributions. All the way, this will run the rest of my life. All the way out to age 120. If I wanted to, that number would not change. And the reason for that is because our lowest point of surrender value is at age 87, 88. So as long as I continue my distributions beyond this time frame, whatever that lowest surrender value is, the distribution will not change. I usually recommend only showing age 100, just because if we show longer than that, it can just look really unrealistic to a client. Okay, but
Quick side
overall,
note here, Danielle. Sorry for interrupting.
yeah,
I know a lot of us as agents, when we're quoting out IULs and you start to feel like you need to limit the distribution years to maximize the amount. Our product, this accumulator product, is designed for what just Danielle was just saying. We are super competitive when you run it all the way out to age 100. So you may be thinking, hey, let's only take it to 90. We're going to get them over that $80,000 threshold. I bet you if we reran this only to age 90, that difference from 100 to 90 is not going to be even very noticeable, right? So
it
please,
usually breaks down to about maybe $100 a month
yeah.
or a few $100s a year. So it's not significant enough to not show your client another 10 years worth of distribution.
Yeah, so please stretch those distributions all the way to age 100. That's how this product is designed and where we want to be when we're illustrating these. So you can ensure to your clients, hey, this amount is not really any different if we run it to age, not assuming a 6.58% return, whether 90 or 100. That's a key point that I think a lot of agents, even myself, I'm out in the field and I do that. Hey, I want to limit these so I'm winning this distribution race. It's not going to change it that much with an extra 10 or 15 years of income when you're illustrating it.
So I'll pull that up and just kind of show you what that looks like. But overall, oops, it disappeared. Hang on. Overall, what you're seeing here is I am paying 300, sorry, it's the other illustration is loading, so bear with me. I'm paying 300 and some $1,000 total into this policy for $700,000 death benefit, and I'm getting millions back, right? I'm at $2.8 million. And I paid $336,000 into it. That's a heck of a return. We obviously illustrate all of these on a loan base. We illustrate these based off of that loan never getting paid back to us. So what you're seeing here is no loan getting paid back to us and the best possible loan. We offer a participating fixed loan. So while the money is being distributed, the funds are still participating in the index, so it's still growing cash value. So just to show you what that looks like, if I stopped the distributions at age 87, which is where that bottomed out at, our distribution changed by how much? Did it even change? It didn't. It changed by $300 a year. But I'm only showing distributions to age 87. Why would I show that when it's only $300 a year? If that makes sense. All right, what questions do you guys have on this product? There's a lot to this product. It's used
What's
for a
the
lot of
age
things.
range, Danielle? What's the age range, cutoff age at least?
For issue?
Yes, to write.
Sure. So age range, oh, if we go back, I can never remember off the top of my head, but we can go
79,
product
I believe.
info. I think I'm not sure. But did you see that? I just clicked on product info and it brought up the product guide. So if we go to the accumulator here, there's a feature card right in here that will show you everything that you need to know. So for this
75.
one,
Yeah.
75 for the accumulator and the accelerator, and then it's 79 for the protector. Okay, so the other thing that I'm going to show you, just to kind of help you guys figure out where your clients are going to be, is on the Midland homepage, which you guys will all have access to once you all get appointed with us. We do offer our underwriting guidelines, which covers kind of everything. But then we also have a medical reference library as well. So obviously here we're going to go over things like tobacco usage. We're going to go over what the requirements are for traditional underwriting. We're going to go over height, weight chart, that kind of thing, right? And some very general things for different age ranges. There is a little bit in here in cancer as well. So these specific types of cancer could qualify for a preferred rating. Anything else is not going to be eligible for preferred. Okay.
Danielle, I actually prepared a little something if you want me to dive into some of the
Yeah,
underwriting
go for it.
things. Guys, I think first off, great job, Danielle. Nobody had any questions, so you must have knocked their socks off. Basically, what I wanted to get across to everybody here, Midland's underwriting philosophy, I think, is pretty straightforward. Okay, I think Midland takes a more common sense approach to underwriting when you compare us in the industry. Right? Number one, I think we're not looking to for reasons to decline. Our underwriting department is truly looking for reasons to say yes to your clients. I can promise you that. Okay. I would say the best way to describe it is fast. Number one, we're fast because we have our right-of-way program. Our right-of-way program, your clients who are 0 to 50 years old can get up to $2 million of coverage without having to do a medical exam. Okay, so that's our accelerated underwriting program. Clients 50 to 60 can get up to $1 million of coverage, possibly without having to do a medical exam. Okay, so fast, fair, consistent, I think, is what you're going to see with us. And to dive in to some of the more common issues that all of us as agents run into. All right, I'm going to touch on a couple of them. Tobacco. Okay, if somebody has not used nicotine in the last 12 months, you could be considered non-tobacco. Okay. Even an occasional cigar use can still qualify for non-tobacco ratings with Midland. And a more prevalent topic that I think a lot of us are running into out in the field is marijuana usage. This is actually a key point inside of Midland's underwriting. We can treat marijuana as non-tobacco usage as long as their usage is minimal. Okay, so if you're an agent out there, you have somebody who uses marijuana, I would advise them to go to twice or less per month. All right, everybody follow my drift there? Twice or less a month.
I have a question on that, Brady, because I talked to you about this already. So if I have somebody that was like downgraded to standard tobacco and
Yep.
it was like occasional vaping use. Is it something she can get re-underwritten after a year?
Yes, yes. If it was like, is she only marijuana usage, or does she use a vape
It,
like nicotine vape?
I think it was just, from what I understand, it was just like a vape. She vaped within the last year. And so I think it was cannabis.
Okay. If it was only cannabis, yes, that frequency question has been asked. And if she was rated tobacco, I'm sure that frequency question was greater than 2 times a month. So if something changes in the next 12 months, please reach back out to us and we can submit it to underwriting for a re-review. Yes. But if it's a nicotine vape, that's a different story. That's going to be tobacco with us. Also, a key point I think out there with a popular product that's out there right now is those Zen nicotine pouches. Okay. Some carriers are differentiating here because of we don't have a lot of history with these products. Right now at Midland, that is a tobacco usage for us. So Zen nicotine pouches is tobacco usage. But to kind of summarize that, even if somebody is a celebratory cigar user, you can still be considered a non-smoker with Midland. Marijuana usage, you can be considered non-smoker, even all the way up to preferred non-smoker with Midland. All right. The best thing to be there is honest with underwriting with those two usages, and less than twice a month with marijuana usage is what we're looking for. So, sneak peek there. I would say
Or once a
moving.
month if you want best
More
class.
often than twice a month.
Yes, sir. Yep. That's what they're looking at there.
They can still qualify as a non-tobacco class. They would just be standard.
Right. I would say the next most common things that we run into as agents out there in the field, blood pressure and cholesterol. Okay? Blood pressure and cholesterol, you're going to run into with a lot of your clients. Really what Midland is looking for on the underwriting side with those things is how is it managed? Right? Is it under control? Do the cholesterol numbers look reasonable? They are still in the running for a preferred class with high cholesterol, high blood pressure, right? Nothing about needing medication with those two things will disqualify somebody from getting a preferred best class. All right. Midland really rewards, I would say, management and follow-up care with those things. Okay. Moving on. A lot of us run into build issues with our life insurance clients. Midland has a pretty wide range build chart, guys. All right. So plenty of folks will land in that standard or even better category depending on everything else that's going on there. Right. So I'd advise you, if you have somebody that you think needs to be a little taller, take a look at our build chart here. We'll give this to Peter and he can distribute this to everybody. But Midland is pretty liberal with our build charts. So don't count somebody out if you think they need to be a little bit taller. All right. Next one, Peter specifically mentioned this earlier. Diabetes, right? And I think this is a big one. Diabetes is very common, right? And Midland sees a lot of these cases. I would say here's the good news. Again, with solid control and consistent follow-ups with your diabetes clients, type 2 diabetes can be standard or even close to it, right? There you go. Type 1 cases are really when the conversation changes, right? They're going to look at other health history there, date of diagnosis, age of diagnosis. You know, you're still in the game with type 1. Control is what they're looking at there. All right. I would say it's not about the diagnosis with diabetes, it's how it's managed. All right. So don't count us out here. I would say moving on, heart history.
Question, what's the
Yes.
A1C cutoff for type 2 diabetes?
Yeah. We're going to be wanting to stay in that 7.0 range.
Okay.
Okay. Moving on, heart history is a big thing that all of us run across, right? And family history. If someone has no personal heart issues and they're taking care of themselves, right? I mean, preferred as possible, even with a family history of heart concerns. right? I would say what you need to be aware of is that family history matters less the older your client is, obviously, right? Once it gets past a certain age, Midland we may not even factor that in at all. So you may be sitting in front of a client that has a history, a family history of heart disease. Well, don't count Midland out here. All right. We're still super competitive with that. I would say leading into the next thing is cancer survivors. Danielle had that sheet up a little earlier. Most of the time, it's that 5 year look back or 10-year look back, depending on their age range. All right. And I will tell
And
you, Midland, yes.
we do have in the underwriting guidelines, again, that was these are the ones that can potentially qualify for a preferred. But some of the more serious, more common ones are listed on this medical reference library. So there's different cancers that are listed out here. So if you come in, this is kind of what you're going to want to look at as far as how do I ask for a risk assessment? These are going to be the things that that our underwriters are looking at. Okay.
So basically, what they're looking for there, again, is management. How early were they diagnosed? What's the management of it? Clean follow-ups for a year's number of time. That person could still qualify for preferred. Okay? We do not automatically knock out people with a cancer history. All right? I think I kind of started this conversation with saying, we don't look for reasons to say no. I can promise you. Midland is an employee-owned company. We are one of the largest privately owned companies in the United States. All right. All of the employees that you interact with inside of Midland have an ownership mentality. We want to get that pace Cade just as bad as you do. Trust me. Okay. So, um, I think saying all of this leads me to the point to say, with your relationship with Midland, you guys have a direct relationship with Midland. You have access to every department inside of Midland. You have a client that you think, hey, maybe I should run this by them and see how they're going to rate this person, or even if they'll get accepted at all. You can actually reach out to Danielle or I, or you could call our underwriters personally, right? You could call them directly. You can reach out to them. And I'm actually going to throw up here in the chat box. So if everybody takes a quick minute here, I'm going to give you the phone number into Midland, and I'm also going to give you the extensions to our underwriters. Okay.
If you
So
could, Danielle, pull up or show everybody where they can find the field underwriting, what do you call that? The form, the pre-forma that you could fill out regarding, to pre-qualify somebody for field underwriting.
Yeah, I can just send it. I'll just send it to you, Peter, if that works.
Well, that works. Yeah, I'm sure
Yeah.
I actually have it, but everybody needs to become familiar with that, because if you're not sure, filling that out and submitting it to the underwriters that Brady's going to be connecting with, this is how you can clear the path for these opportunities by pre-submitting these things and knowing whether or not this is even an opportunity. It really does expedite the business of properly rating these policies out and these classes.
So please feel free to reach out to Danielle and I if you guys have specific questions. Maybe we went a little too fast for you today and you wanted to do this again personally. We'd be more than happy to do that. But also when it comes down to actually the rubber meeting the road, I have somebody sitting in front of me. I'm ready to take an application. How will this person be treated inside of Midland? Please look in your chat, take a quick screenshot of this. You can call our underwriters directly. You can email Danielle and I or call us directly, and we can give you an accurate rate class of how you should be quoting and submitting an application for your clients. Okay. That's what I have for underwriting, Peter. Did I miss something?
No,
Is there any
that's great.
questions?
Yep. No, that works. I want to just open it up to other people's questions, because I know with cancer, the look back period, if I remember correctly, is 3 years. Is that correct?
10 years, I believe.
Is it 10 years?
I do believe, yes. Some cancers will be 10 years, some will be 5 years, just depends on the type of cancer, but 10 years is probably what I would go by.
And what's the look back on heart attacks or heart
Let's
disease?
pull up here, let's pull up an application because it'll ask on there.
Because I know the three biggies that we run into consistently: heart attack, cancer, and diabetes. Those are the three most
Yep.
common. How are we rating these people based off of those three priority issues?
And I'll tell you from experience, I've seen every single one of those has been able to be looked at and qualified on an, obviously individual basis, but
A good rule of thumb, guys,
absolutely.
5 years. It's a good rule of thumb. We want to see 5 years of no heart attack history, no stroke history, no cancer history.
Can we go back to the illustration you showed with the cancers, please? I just had one more
Mhm.
question on it. I work with a support group with men with prostate cancer. I
Yeah.
just need a little clarification on that. If you can go back to the slide.
Yes. Yep.
Okay, this is for a preferred rate only, so they could
This
qualify
is
for
for a
standard.
preferred rate. Yep. So they could
Okay.
qualify. So if we go up here, let's see if
Yeah, because
should be
now
in here
a
as
lot of
well.
doctors are electing proton therapy rather than removal of the prostate.
Yeah, so here is what we have currently. And if we do update these regularly, so as recommendations and things like that change throughout the life of treatment, right? Because we know that that changes regularly, we do update our underwriting guidelines to try and follow, so we're not staying behind the times.
Thank you, Danielle.
Mhm. So I'm looking at the application right now, and here, I'll just bring this over. Here's just our traditional application. The questions will be the same, but these are the part 2 questions. These are the have you ever been questions. So that's where you're gonna find your cancer, your heart questions. So those are ever, but just because they've had it happen before doesn't mean they're not gonna get approved, okay? I just want to make sure that, like Brady said, they're doing their follow-ups, they're taking it seriously, they're doing what they need to take care of themselves. And the further and further we get away from those events, the more likely they're going to be able to get approved and with a better class.
Okay.
What else do you need to see? Otherwise, I can stop sharing my screen and I'll
No,
make sure to get
I'm
all
sorry,
of
I'm
these
good.
sent
Yeah, I'm
out to you
good.
guys.
Thank you. I'm
Okay,
good.
perfect, perfect.
Does anybody else have anything that they want to raise? I mean, this is the time to do it. We've got them here on the line with us. Okay, is there a give me something as far as an advantage that exists over North American with Midland as far as the underwriting? There's got to be some niche that really we accept this, they don't, or we take this, they don't.
We use the same underwriters.
Yep.
North American and Midland use the same underwriters and same guidelines. The advantage lies with your relationship with Midland. Okay, as I was mentioning earlier, if you were doing North American business, there's somebody or something in between you and us. And so the advantage there being If you were only writing North American and you call in and represent yourself as a North American agent, they will revert you right back to that middle person.
Yep.
Okay. The advantage lies in being direct with Midland. That's the difference. We have the same product, same pricing, same everything. The advantage lies with you being direct to us. You are able to call those underwriters now directly and speak with new business directly or speak with our sales support team directly because you are a Midland relationship. So keep that in mind.
And the benefit of having that direct relationship, especially when it comes to underwriting, is that we can watch the cases a lot more closely and we can get the story. Our underwriters are very holistic. So if we can get a full picture of the story, like, hey, we're only doing a term right now, but we're going to be converting X amount gradually over the next 5 years into this, right? We want to know all of the stuff. We want to know the whole story, not just what is their health and who are we in competition with. We want to know the whole picture. And so I know I'm a bulldog when it comes to fighting for what's gonna work for you guys and making sure that we're getting our clients the best results. And there have been several times where I've gone to bat with or against underwriting, I guess I should say, for you guys as the advisors to make sure that I'm getting you and your clients the best deal, because there's several advantages, as you may know, to staying with the same company instead of having to flip flop back and forth between, well, is this company, and then your clients have to fill out multiple applications. We don't want that. We want you guys to stay with us. If you've already done one, tell me what they've done, what that other company says they can do for you, and we'll fight. Okay. I will fight for you.
Awesome. Awesome. So any questions, anybody else on either of the products that we covered today? Let me just ask one more thing because we have just a couple minutes here. When is a MEC an appropriate solution? Does anybody have, other than Brady and Danielle, when is a MEC an appropriate solution for a client? Nobody. I'm interested to find out if anybody else knows when you use a MEC. A modified endowment contract.
I never knew that was even a reason to use it. I thought we're trying to avoid that.
Now, in certain estate planning cases, I know it has an advantage, but I can't remember what it is.
Very good. So think of it as this way. If they're healthy, a modified endowment contract gives you all the same benefits that you have with an annuity, but an amplified tax-free death benefit. Okay. So you can create a MEC policy through multiple opportunities, whether it's a single premium, whether it's a PDA, whether it's transferring qualified funds into a qualified MIGA and doing distributions. I mean, there are ways where you can still create the MEC policy, because really what the client's looking for is to make sure that their kids get the money tax-free. So there are ways to convert qualified funds into tax-free benefits or emphasize a superior growth rate, because once again, this was an issue in the past, not so much now, where a lot of the annuities were capping out at very, very low levels, and the life policies still had much better caps and participation rates, or had better fixed rates. So the MEC policy really comes into play when you're trying to do a parallel with all things being equal with an annuity, but you want more death benefit and you want it tax-free. And that's really the advantages that you can bring in with a MEC contract. Outside of that arena, is there anything else I'm missing, Brady, that you can think of, or Danielle?
For a MEC?
Yeah.
I've seen it a lot, obviously, in that scenario where we're looking at estate, but I've also seen it a lot when it comes to like real estate. People who buy and sell homes, they know they're going to get taxed, but the accelerator does a great job of, the accelerator is the accelerator. It's named that way because we accelerate the cash value, right? It has its best growth usually within the first 10 to 15 years. The accumulator is long-term cash growth, so we don't want to use it for that. Plus you get that waiver of surrender charge. So if you do need to throw a huge chunk of money in and take it out within 2 years, 5 years, You can take it out, your surrender charge is waived, and then whatever you have is just taxation on those gains.
Yeah, I see it most when you're maximizing the death benefit, guys. It
Let me
doesn't matter if you don't plan to take loans or withdrawals from your policy. That death benefit, when we are maximizing that and throwing cash into a policy, that mech doesn't matter.
Mhm.
And not all carriers will let you make their contracts. Let's be clear on that. Some of them don't want you to do that. Can you find out if they will accept a mech as a 162? Just out of curiosity.
I can find out
Yeah.
for you. Typically,
I don't
Like-
see any
design and
reason,
you're
yeah, I
doing
don't see any
withdrawals and
reason why we
loans.
wouldn't.
Yeah, if like you're doing like a single premium drop in, right? They want to do a one and
Yeah.
done play here, right? And we know it's going to be taxable on the back side, but it would be the same as if we did an annuity 162 variant. So I don't see that why it shouldn't, but it'd just be interesting to know if that's a capacity, because then they pick up the added death benefit and living benefits over what they could get on the annuity side. So that would be some additional amplification. So if you'd find out for me, I'd like to know that.
I
So
certainly
we
will.
have, let me share my screen again here real quick. I want.
So just to be clear, everybody, mechs are not a bad word or a dirty word. You just need to know
No.
how to use them for the appropriate situations.
Okay, so here in our home page, can you guys see my screen?
Yes, it's showing up
There
now.
it is. Okay, there it goes. So we have all these recorded webinars. We have got webinars that we host on a monthly basis. And then one of them specifically, where did I just lost it. One of them is specifically is titled to mech or not to mech. So we
right there.
have, yeah, I don't know where it is.
Go up.
It's right under DIU
There it
up.
is.
Yeah, there you go.
So we have resources out here for you, tons of them. This is just a recorded webinar. They go through the whole process of everything that you're seeing here, right? So we've got tons and tons of resources out here. So you just let me know if you're looking for something. That's the whole thing, is people don't understand that the role that I play and the role that Brady plays in this company is way different than any other company that you're going to see. We're not just here to recruit you, right? We're here to maintain you and make sure that you stay, because we want to keep you happy. And so if you utilize me, please, I'm underutilized. So if you need help running your own illustrations, because I'm not available 24/7, but I'm happy to show you how to, so that if you're meeting with a client on the weekend, you can do that right in front of them. How impressed are your clients going to be? But if you have some paperwork or you need something done and you don't know who to reach out to or where to find it, please utilize me. I am happy to help you.
Well, I can say I appreciate both of you very much and the partnership with Midland to bring about some of these things. We've got some great opportunities and activities going forward, and just wanted to again say thank you for taking the time to present with us today.
Yeah,
Thanks
thanks
for having
guys.
us.
Appreciate it. Looking forward to meeting all of you.
Yep, I need to get with you about our February event, Brady, because I've got some more specs on that, and I'll send that over.
Sounds good.